Hey guys, what's up? What's up? What's up? It's been a while. And so, as I promised again, I'm pretty sure I start all my YouTube videos saying, as I promised, as I promised. Well, it's true. So, as I promised in the previous video, not in the previous video, holy shit. As I promised in Telegram group, I'm going to be talking about doubling theory and market structure. So, we're going to be looking at how doubling theory can be used alongside market structure or how market structure can be used alongside doubling theory. Okay, it's going to get a bit interesting, so stay tuned and watch till the end. Okay, so now market structure. What is market structure? Now, the way that I look at market structure and the way that we look at market structure in the Trading Academy is very different to the world of ICT and to the world of smart money concepts. Okay, we will be using true points of valuation to gauge structure and guide us on how to effectively place stop losses with our trades. That is the philosophy that we are going to be taking when we view market structure from the lens of the Trading Academy. Now, market structure from the Trading Academy's perspective is based on the manipulated range. Now, as you guys know, the manipulated range is something that I was talking about for the past 2 years now, and I put on YouTube 1 year ago, as I sent to you guys on the Telegram group. Okay. This involves using the price point or the leg of price that takes our liquidity or the leg of price that goes into a fair value gap and then causes a swing there. Okay, so the general premise is that price will come back to refer to the manipulated range's equilibrium, so the midpoint of the manipulated range, before continuing its expansion. So for example, if you're going higher, then we want to see it retrace down into the 50%, and then you're of course going to keep your stop loss below the low. Now, there are edge cases of using the 25% and the 75% based on the in-range mitigations prior to the breakout. So for example, if you have something like this, right? So if you have, it's your range, this is the implied 50%, price mitigates it there and then goes up, breaks it. So this high to this low is your manipulated range. So at this point, we are going to be using the 25%. That's your entry point there. Stop loss is going to be a bit wide, unfortunately. And your take profit is going to be the N30 projections of the manipulated swing point. Okay, and you will see price turns over there almost perfectly. All right, not forced standard deviations, nothing like that, right? If you understand which range is being used, you will understand the projections that you can use as well. Okay, here's an example over here. That's your manipulated range. See, we have this low that led to this high, filling up this wick. So wick is also a form of a gap. Measure that out, and that's your 50% there. And you're going to sell it there. Okay, that is an example. Now, putting it together with doubling theory and the power of three expansions. Now, the retracement itself, okay, is categorized as a phase of reaccumulation because you know that when there's a retracement, it is a reaccumulation. So the usage of the manipulated range structure can be best seen having great utility during the phases of accumulation and manipulation. Okay, now we know that during the distribution phase, price is moving really fast. So that we can use our fractal dealing ranges. But when it comes to accumulation and manipulation, price has to keep on accumulating and then it has to then displace into one side doing the manipulation. So between the accumulation and the manipulation, you can use the manipulated ranges to essentially get the best and fastest move that you can get in the marketplace prior to the distribution, because we know that manipulation is the fastest move in the marketplace and manipulation is a fractal distribution. So that means after the manipulation, when you have that bigger distribution, that is also part of a manipulation on the higher time frame. Take a look. This is your accumulation phase. Here, let me get my pen out. Accumulation, stack sell side, manipulation. Okay, and then that's the distribution. When the distribution is done, price will then come and accumulate again, right? But now we can see that prior to the ending of the manipulation, see how we have this manipulated range here, this range here. So as we break down these structure points, we're going to be expanding our manipulated range. It's a dynamic tool. So right now, here, At this point of breakage, we have this entire range to contend with, and that's the equilibrium. Yeah. And that's your short. Take profit will be stack liquidity or two standard deviations. So if I were to do this by sight, it's 1, 2, yeah, more or less two standard deviations, and then you'll see that price turns immediately after that. Okay. I've been proving it on the Telegram group, so you guys can go and check it out. Okay, so that's pretty much it. So I hope you found this insightful, and I might get on Twitter and I might post my trade ideas on Twitter so you guys can follow along. So just go find Sean underscore D underscore Y, something like that, on Twitter, and you guys can go ahead and follow me. You can interact with me over there. And the ground rule is that if you say shit, unnecessary shit, if you are going to start some trouble, you're going to be blocked. I'm not coming to Twitter for just to fight anyone or prove anything to anyone. I'm just coming there for fun. If I find it boring, I'm just gonna leave. Okay, so get the value when you can, because if I do decide to leave Twitter, then unfortunately it's too bad on you, right? Yeah. So with that said, I'll see you guys in the next one. Good luck and good trading. Bye bye.